Hi guys, this is a new section. So this section will look more into like one specific topic and go into a lot of depth. Obviously, I won't talk about every possible sector within a topic. However, I'll go over like a big amount and we'll try to teach and explain as much as possible. The most recent lesson right now that we have is lesson 3, and I looked at mutual funds and ETFs. Sorry, that's going to be lesson 4. Lesson 4 looks at mutual funds and ETFs. And I go a lot about ETFs, and I do explain what a mutual fund is, but it doesn't go into great detail. And if you're still wondering what a mutual fund is, this would be a perfect lesson for you. As the other lessons go by, and I see that there's a topic that could be taught even more, I'm going to put into this sector, and we're going to go through that topic even more. And in this case, we're starting off with mutual funds. So in this lesson, we will first start off with the structure. We'll start with the legal DNA under the Investment Company Act, then walk through how part 2 would be the net asset value and NAV is calculated, and why your orders always fill at tomorrow's price. From there, we'll explore every major fund category, from money market to long short. From money market to long short, before dissecting fees and share classes, so you never overpay a load again. We'll pit active manager against index funds, decode alpha, beta, Sharpe, and information ratios, and show how taxes can eat half your return if you're not careful. And then finally, we'll swap mutual funds into real world portfolios, expose the behavioral traps most investors fall into, and finish with the due diligence and checklist, so you can see a due diligence checklist you can use on any prospectus. So for the due diligence parts and takeaways, I'm pretty sure I combined it more into one. And structure is the most important, so we're gonna start with this, and then kind of as we go down, it gets not necessarily simpler, but more flowy. I don't know how to explain it, but yeah. So first things first, we gotta talk about the DNA, also known as the structure. So a U.S. mutual fund is technically an open-end management investment company governed by the Investment Company Act of 1940, often called the 40 Act. So if I ever mention the 40 Act, that's what I'm talking about. So open-end means the share counts expand or contracts every day. When you invest, the fund creates new shares at the night's net asset value, and when you redeem it, it cancels shares and sends you cash. There is no fixed float like a closed-end fund. Shareholders elect an independent board of directors or trustees. The board, by law, owes you a fiduciary duty. It negotiates the advisory contract and reviews fee annually. The investment advisor, so we're going to think of like Vanguard, Fidelity, BlackRock, actually runs the portfolio. They're paid an advisory fee, which is the largest line item inside the expense ratio. A custodian bank such as State Street or BNY Mellon physically holds the stocks and bonds, ensuring none of them go missing. A transfer agent keeps the shareholder ledger, strikes the daily NAV, and handles your purchase or redemption request. So when I say NAV, net asset value. And then finally, a distributor or underwriter markets the fund and collects any 12b1 distribution fee or sales loads. I'll explain what 12b1 is soon. Sometimes the advisor and distributor are the same corporate entity. Sometimes they're separate. So for U.S. tax purposes, the fund elects subchart M status, meaning it pays no corporate income tax, so as long as it distributes more than 90% of its net investment income and capital gains to you each year. Canadian open-end funds follow NI 81-102, and in Europe you'll hear the term UCITS, but the plumbing is remarkably similar. The key takeaway is that a mutual fund is regulated passed through trust with multiple independent gatekeepers whose job is to protect you, the shareholder, from conflicts of interest and operational risk. So NAV. So what is a NAV asset value? Let's talk about price discovery. So mutual funds don't trade all day like ETFs. They're priced once after the market closed using a forward pricing mechanism set by SEC, and SEC is the Securities and Exchange Commission. And this falls, not that important, but this falls under Rule 22C-1. At exactly 4 p.m. Eastern, the trading day ends. Every open-end fund gathers its portfolio final quotes, then the pricing committee fair value anything illiquid or foreign that hasn't traded recently. So, Australia-listed stocks, for instance, are adjusted to prevent overnight pricing arbitrage. Now, what is arbitrage? Arbitrage is basically a kind of like a, I don't know how to explain it, but it's like a little not a mistake, but like an irregularity. So like, let's say in very simple terms, let's say we have three currencies and we're trying to trade in between. So let's say you could go from American, Canadian, Canadian to Euro, Euro to American, and American back. So when you have your American, let's say you start with $1 American and you transfer it to Canadian, that Canadian then gets transferred to Euro, and Euro to American. By the end of those three conversions, your American dollar will be valued more at the end than when it started, and that's considered arbitrage. There's obviously different types of arbitrage. In this case, we're talking about mutual funds, and the way arbitrage is canceled out is usually with fees, but that's basically just a simple definition of arbitrage. I will throw up a definition of arbitrage on the screen so you could read it. I'm not that good at like throwing out definitions because I kind of planned for this lesson. Anyways, okay. So the formula is straightforward. If we look at NAV, so it is the sum. This is this notation sum. Sum the fair value of every security, and then you add any accrued dividends or bond interest, subtract the liabilities like management fees owed, and then divide this by the shares outstanding. So accrued income minus liabilities is added to the sum fair value, and then is divided by the shares outstanding. So this gives us single net asset value, and it's the only price at which the fund will create or redeem shares that day. Your order timing is crucial. If your broker logs an order at 3:59, you'll get today's net asset value. Miss it by a minute, you settle at tomorrow's price. That eliminates intraday trading, but also means no bid-ask spread. So remember I mentioned what a bid-ask spread is, and so this you will always buy or redeem a true asset value. Settlement in the US is typically T+1, so cash moves right here. Cash moves and shares cancel the next business day, and the new SEC. I'm gonna say SEC. I'll say SEC. So new SEC, which is Securities and Exchange Commission. New SEC swing pricing rules now let funds slightly adjust NAV when flows are heavy, protecting existing shareholders from dilution. So why does this matter? Well, understanding the forward pricing helps you avoid surprises, especially around volatile markets, closes, or overseas holidays, and explain why mutual funds are better suited for long-term investing than rapid trading. So there are different fund categories. The first one is money market funds. It's an ultra-short treasury bill, repos, and commercial paper. They target a stable $1 share price under Rule 2A-7. Great for parking cash or corporate treasuries, not for beating inflation. Another one is bond or income funds. Anything from US Treasury to high yield corporate. Duration, credit quality, and sector mix drive risk. So example is VBTLX, total bond, and a JNK high yield. Another one is a core equity fund. Large cap US blends into the workhorse. So you can think of VFIAX, tracing the S&P 500. Or growth value style boxes like FCNTX and VVIAX. Equity supply, long run capital appreciation, but come with volatility. Another one is balanced asset allocation. Classic 60-40 stock bond mixes the rebalance for you. They smooth the ride but cap upside compared with all equities. Vanguard's Wellington is a textbook example. There's target date funds. I just realized I actually did not put balanced in here, but it's okay. Target date funds, they embedded a glide path, heavy equity in early years, drifting toward bonds as the target retirement date approaches. Perfect defaults in 401ks. Just pick the vintage matching your planned retirement year. There are sector/thermic funds. These are pure plays on tech, energy, healthcare, or narrow themes like blockchain or climate transition. Useful satellite but carry concentration risks. Own them only if you understand the theme. And then right here, this is just suggesting alternative strategy funds under the 40 Act umbrella, but run hedge fund like playbooks, long or short equity, managed futures, market neutral, merger arb. They promise diversification, yet often charge higher fees and can lag in bull markets. Closed-end and interval funds add another wrinkle, fixed share count or limited liquidity periods, but today we're staying with true open-end funds. So we're going to just quickly mention a takeaway for these fund categories. Each category serves a precision role: liquidity, income, growth, or risk diversification. Knowing the bucket tells you how to plug a fund into your overall allocation. And then next, we're going to look into fees, share class, and loads, so you never pay more than you need. I do want to say that this is a lot of information. I'm not trying to keep these videos like 2 hours long. I could go into great depths on each category and give you examples, and as well as things I mentioned before and that I will mention soon. Just if you don't understand something, just pause the video and try to re-listen and do some research on the side. But yeah, this is just like, I'm just throwing in information and then you can build on from this. Fees. So fees sound tiny until you do math. This is basically saying that fees are very, very important, and since mutual funds are more like a long run thing, your fees will eat you up. So you gotta understand fees properly. So let's start with the expense ratio. On the left right here, we're gonna look right here. You see a stacked bar. The slice is the advisory fee that pays portfolio management. Then this one right here, the 12B1, also known as the marketing fee, so I mentioned it earlier. The other slice right here covers custody, auditing, legal, and admin. And combine them, you have a total ongoing expense ratio. So in this example, it is 0.8%. And then index funds like Vanguard 500 run closer to 0.04%. And then niche active funds exceed 2%. So this one's kind of, we could say, in between in a way, not really. It's closer to a Vanguard type, but yeah. Now the share class. So right here we have A, B, and C. Class A shares hit you with a front end loan. Think 5% off the top, but compensate by lowering their annual 12B1 fee to 0.25%. Breakpoints cut that load for bigger tickets, so large long-term investors sometimes prefer A. Then we have Class B. Loads are mostly extinct, but you'll see them in older 529 or 401k plans. No front load, but a contingent deferred sales charge. 5% if you bail out on year 1, sliding to 0 after year 6. And then like a fat 1% marketing fee while you wait. And then we have Class C is the level load class. 0 upfront, a small 1% back fee if you leave inside 12 months, and a perpetual 1% 12B1. Great for brokers who want a steady trail, and it's terrible for compounding over decades. And the last one, we have institutional or iShares. Skip the loads and trim the expense ratio razor thin, but you need a 7-figure ticket or an employer plan to access them. And so why does this matter? A 1% fee seems harmless, but the call-out math shows you forfeit roughly 25% of your ending wealth over a 30-year horizon at a normal market return. I'm going to show you this right here. Multiply that across retirement assets, and you're talking about delaying retirement by years. Some tips I do want to mention is always compare load adjustments. Right here, always compare load adjustment, net of free returns. Morningstars and your prospectus show both. In taxable accounts, remember loads are part of the cost basis, slightly offsetting capital gains later, but there's still money gone today. Inside retirement plans, lobby HR for institutional share classes whenever possible, and a 0.4% savings on a lifetime contribution is real money. So right here, as I mentioned earlier, that 1%. So if we have $10,000 at 6% for 30 years, we have $57,400. Obviously, we have to adjust that for present value and future value, but that's not that important. The same return minus 1% expense ratio is at $42,900. So you lose $14.5 thousand, which is roughly 25% of your fees. So this is, if you multiply this by another, add 25% to this, it would be this. So that 1% in 30 years made that big of an adjustment. Active versus passive. So this kind of looks like, can skill beat the benchmark? So passive index funds, a passive index fund are rule books, not people. They follow a transparent methodology, usually market cap weighting. So let's say if Apple is 6% on the S&P 500, it's 6% of the fund. Turnover is a minimal cost. However, turnover is minimal. Costs hover near zero. And because trades happen mostly during quarterly rebalancing, taxable distributions are tiny. Active funds on the right hand, they're plain called to manager or quant model. The promise is positive alpha, which is extra return after adjusting for market risks. But that discretion comes with higher turnover and much higher fees. And so the hurdle becomes, can the manager beat the benchmark by at least his cost and your taxes? Tracking error, which is right here, is the yardstick for both worlds. For a good index fund, you want that standard deviation of return difference down around 0.05 to 0.2%. Anything above 0.5% signals sloppy replication or high cash drag. For active funds, tracking error is intentional. The manager is taking benchmark relative bets. Think of it as the risk budget she spent to hunt for alpha. The boxed equation right here shows classic signal factors, kappa and alpha. Fund return minus the risk adjusted benchmarking. So Morningstar, Bloomberg, and your prospectus performance summary table all quote this. A positive alpha that survives fees, taxes, and multiple market cycles in the Holy Grail are incredibly rare. So according to the latest SPIVA scorecard, which is in the footer. According to the latest SPIVA scorecard, nearly 4 out of the 5 U.S. large cap managers underperformed their index over the past decade. In less efficient niches, small cap value, emerging markets, active success rates improve, but fees usually rise too. So what is the bottom line? Use passive for broad, efficient market. Deploy active only where you have high conviction of the manager edge, capacity, discipline, and a fee schedule that won't cannibalize the edge, with cost and alpha in mind. Our next slide, which I'm going to talk about right now, will look into performance and risk metrics, which you'll need to judge any fund apples to apple basis. So here are the metrics. So numbers don't lie, if you know which ones to read. Let's start with the obvious. Total return, which is right here. It's the rate of return, includes reinvested dividends and capital gains distribution after fees. Great, but return is meaningless without risk. Standard deviation measures, which is right here, standards measures price variability. Think of it as your portfolio's mood swings. Most U.S. equity funds live in the 15 to 20% range. Lower standard deviation at the same return is strictly better. So it just means how far you are from off the average. Lower, it means you're closer to the average, or not that far from the average, which is good. Beta tells you how violently a fund moves relative to the benchmark. A beta of 1.2 means 20% more volatile than the market. Under 1 is defensive. Pair beta with alpha, the vertical intercept above the security market line. Positive alpha after fees, and with T-stat greater than 1 is rare gold. So Sharpe and Sortino's ratio translate risk. Right here. The Sharpe and Sortino ratios translate risks adjusted into one number. Sharpe uses total volatility. Sortino penalizes only downside moves, which most investors care about more. Anything over about 0.6 Sharpe or 0.75 Sortino over a full cycle beats 80% of funds. For active managers, the information ratio, which is IR, is the king. X is return divided by tracking error, which is the formula right here. A 1 IR means every percent of active risk buys you a percent of outperformance, which is elite territory. Finally, look at the max drawdown. The worst peak to slide. In crisis, capital preservation matters most than average monthly stats. So right here on the graphic, I've plotted the index fund steady lower right. And a hypothetical active manager, hopefully upper left, and peer cluster dots, which are here. Your goal is to live as far northwest as possible. So you want more return with a less standard deviation. So anything right here would be most ideal. You have a high return percent, but with a low standard deviation. Okay, so it's not what you earn, it's what you keep. Right now we're going to talk about taxes. So under Subcharter M, a U.S. mutual fund pays no corporate tax if it passes almost all of its income and realized gains to shareholders each year. On distribution day, the tax bill basically teleports from the fund's balance sheet onto yours. So right here, the table that bill into 5 buckets, 1, 2, 3, 4, 2, 4, 5, yeah, 5 buckets. Qualified dividends and long-term gains enjoy reduced rates, 0 to 20% in the US or 50% inclusion in Canada. Everything else, ordinary dividends, bond interests, short-term gains is taxed like salary. So a high turnover growth fund that clips short-term gains every month can quietly vaporize 2 percentage points of return. So the diagram at the top shows the flow. So portfolio gains goes into mandatory distribution, immediate taxation, even if you reinvest. Holding the fund in tax advantage wrapper. So 401k, IRA, TFSA, RSP defers or eliminate that hit. Right here we could check the math. So a flashy active manager who posts 7% before fees looks great until you subtract the 1% expense ratio and almost a percent of annual tax drag. Net, you're barely above 5. A boring index fund at 6% gross with near zero fees and almost no taxable distribution actually leaves you with higher take-home growth, as you can see right here. So portfolio fit and behavioral pitfalls. So we've covered the mechanics, and now let's kind of plug mutual funds into a real portfolio and dodge some behavioral landmines, which I call. So right here we have the core satellite model. So your core is boring, low cost, globally diversified engine. Think a total market index fund plus an aggregate bond fund. Together, they should be 70 to 80% of your money. And then you have the satellites, which are kind of these. We have these satellites. I don't know why I have satellite 2, satellite 1, 2, 3. So the satellites are where you express tilt and conviction. So maybe a small cap value fund to capture the size value premium, an actively managed emerging market fund where markets are less efficient, or a thematic clean energy fund. So this keeps the satellites in aggregate under about 1/3 of the whole pie. So mistakes there can sink the ship. Right here at the top right, you see 3 rule of thumb asset mixes. They're not prescriptions, they're just starting point alignments to risk appetite at the time horizon. Notice how the cash slips disappears in an aggressive allocation. Liquidity matters less when your horizon is in decades. Now the call out, the behavioral gap, Dalbar and Morningstar track what investors actually earn versus what their funds earn. Because of performance chasing, buying hot funds high and abandoning them low, investors forfeit roughly 1.5% a year. And over 30 years, that's 25 to 30% reduction in terminal wealth, which is far bigger than most expense ratio. There are other traps. So a diversification, so owning SPY, VOO, and IVV, which I mentioned in another video, in another lesson, is triple paying for the same S&P 500 exposure. Day trading a target date fund that designed to be set it and forget it. And then even selling in a bear market because the time is different. Every long-term study shows staying invested wins. The action items, so there's 1, identify your risk profile and pick 1 core allocation models. 2, limit satellites to ideas you can clearly articulate and monitor tracking error. 3, automate contribution, so DCA to short circuit timing emotions. And then 4, review annually, not weekly. To finish it off, we're going to look at due diligence and takeaways. So this is just going to be a list. I'm going to just kind of like what to verify and cute, but I'm going to explain it. So 1, objective and benchmark. Make sure the fund's stated goal and its benchmark match what you actually need in your allocation. 2, manager tenure. Skill compounds, turnover at the helm resets the clock. 3, expense ratios and 12b1. If the fee is above your category median, demand a reason. 4, turnover percent. High trading is equal to higher taxes and slippage. Under 50% is decent for equity. Single digits is excellent. 5 is your risk matrix. Compare volatility, beta, and maximum drawdown against peers, not in a vacuum. 6. After tax return. Morningstar's tax costs ratio translate theory into what hits your pocket. 7 is capacity in AUM. A brilliant small cap strategy can do dual once assets well. Know the capacity limits. 8. Style drift and active share. An active manager hugging the index at 30% active share isn't worth 1% fee. Trading policies and a soft dollar. Soft dollar and market impact costs often hide out the expense ratios. And last but not least, ESG and constraints. Any screens, ethical sector leverage, make sure they align with your value and goals. So what are some takeaways? Diversify broadly with low cost core funds. Use satellite sparring for specific tilts. Fees and taxes are the guaranteed risk-free drag, which minimizes them. And behavioral beat strategy. Automate combinations, rebalance annually, and tune out noises. So right here are some takeaways: diversify, minimize fee, mind taxes, stick to the plan. And then if you do want to practice, you could pull, I don't think I have a slideshow. No, I don't. Pull one mutual fund you own or are considering to buy, and then run through these 10-point checklists and decide if you want to keep, add, or replace. That's pretty much a good way to practice and see. I do want to say this lesson was very, very heavy, and I was mentioning a lot of just information. It is best if you turn on captions and actually try to, understand step by step. I'm hoping the captions do work, but it's very good to just always pause, rewind, listen again, and then if you don't have questions, I'll give you the best thing. If you don't understand what I'm saying, have like ChatGPT or DeepSeek open on the side. You could always ask it questions. These type of questions you ask are going to be definitions. It's not like you're asking to do some type of research which could give you false information. If you tell it what I just told you and be like, hey, expand on this, or hey, give me an example, it will help out a lot. But yeah, that was the lesson on mutual funds. I do apologize. It was a lot of information just thrown at you. Please take your time. I want to make the video short so you guys don't have to like pause every 10 seconds on a 2-hour video. It's better to pause and like try to do a bit of your own research on a 20-minute video or whatever length this one is. I'm hoping it's no more than 30 minutes. I really, really hope it's not. But yeah, I do hope you enjoyed this. I'm not sure what the next topic I'm going to be teaching. But yeah, thank you so much for watching.